Hi everyone, this is Accounting Made Simple with Hakeem. Today I will be discussing IAS 19 employee benefits. IAS 19 employee benefit. This standard describes um, how an entity should record and disclose employee benefits. In certain organizations, in some organizations, let me say that um, um, companies do contribute fund or find a way to pay their employee maybe at the end of the service at some point in time in the form of pension and gratuity, and also there could be a lot in terms of maybe extra share payment or maybe in terms of bonuses to staff. So these standards IS 19 discusses how an entity should record at every point in time when it makes such payment or making provision for such payments in its book. So um, the standard focuses on four major areas, which are short-term employee benefits, termination benefits, other employment employees benefits, then post-employment benefits. Short-term benefits or short-term employee benefit could be maybe in form of annual annual leave payments or annual bonus payments to staff, something that falls within 12 months after the reporting date. We can say that. Termination benefit, maybe a compensation to terminate the employment of a staff. Other employee benefits ranging from um, anything that doesn't fall under short-term employee benefit, termination benefit, and post-employment benefit. Let's say that. But for the purpose of this discussion, presently I'll be talking about post-employment benefit, which is the fourth one. This post-employment benefit has a lot of features under it and has a lot of technicality. So I'll focus this video on post-employee benefit, employment benefits. Then I'll do a separate video for other three: short-term employee benefits, termination benefits, other employee benefits. So, but for this video, I will only look at post-employment benefits. So, what are post-employment benefits? The standard says that they include benefit paid by an entity to its employees after the completion of employment. So we know that, okay, what are those um, benefit that an organization pays to its employees after? It could be in form of gratuity, in form of pensions. There are some organizations that have retirement benefit plans in their policies for retirement of staff. So when they leave employment, or maybe because as a result of their meritorious service to the organization, they have some benefits that those staff will be able to receive after they complete employment for a period of time. Say somebody was employed to on a contract basis, or maybe a period of 10 years. Within that period of 10 years, that organization, that staff must have performed some services to the benefit of the organization. So as a result of that, then employers are expected to make provisions for those, because at the end of the retirement they cannot accumulate everything and just post to the profit and loss account. So they need to make uh, continuous provisions in a particular way, and be able to pay off that benefit at the end of the day. So under this post employee employment benefit, we have what we call defined contribution plan. Defined contribution plan. So let me just put plan here, and we have defined benefits plan. So defined contribution plan, defined benefits. So what are defined contribution plans? So this includes, as the name suggests, is a contribution that's already defined from the start. A contribution. Look, for instance, you want to make some contribution to the fund, a particular fund, so that you can pay staff at the end of their retirement. So that contribution, I mean continuous or periodic contribution that we make at that point in time, is defined. They are like fixed contribution over a period of time. So the contribution is fixed, but what is not fixed is the return. I mean, in the form of benefit that the employee will get at the end of the day. That is not fixed. That is like a variable return. So it's like you contributing a certain sum of money, let's say $20,000 on an annual basis for staff, and anything that happens to that contribution is not organization is not under obligation to make further contribution to the fund. So what the organization only make at that point in time is what the organization will pay. So this is we say that the organization has no further legal or constructive obligation to pay any further amount into the fund. So that's why we say that is defined contribution, because that contribution is defined from the beginning. But the return on that contribution, I mean the fund, if anything affected like inflation or maybe markets forces or anything, uh, the organization is not under obligation to make further payment. So the return could be variable. That is what I'm trying to say here. So it is a simple accounting. It is accounted for by debiting expense or in form of profit or loss account, and also crediting liability as those contributions were made from time to time, or the plan for the contribution. So expenses will be debited while liability will be credited, so that that amount there won't be any further liability that the organization will recognize other than that debit and credits has been recognized. So I won't say much on that because it's simple debit and credit. So I'll go down to what we call defined benefit plan. Defined benefit plan, as the name suggests, you see that when I was explaining defined contribution, I said the contribution from time to time is fixed, but the return is variable. Here is the opposite, because the contribution that we pay from time to time, I mean what the employer pays from time to time, is variable, is not fixed. But the return on the fund, I mean the return, what is expected to be paid to the employees at the end of the retirement, is fixed amount. That amount is fixed. Okay, for instance, say an employee that was employed maybe a year ago is expected to spend 5 years in the organization. So that amount, at the end of 5 years, that employee is supposed to receive maybe $100,000. That $100,000 must be $100,000. So if at any point in time the organization make contribution to the fund and the balance is not up to $100,000, it means the organization is under obligation. That's why I said in the first instance, in the, under defined contribution plan, there's no further legal or constructive obligation. But here, there is further legal or constructive obligation to pay. So what the employer pays is variable contributions, but the return on the fund, I mean the return on the contribution, is fixed at all points in time. So that's the difference between defined contribution and defined benefit plan. So so let me define some useful terms that we will come across in the process of trying to solve one problem or the other. Examples that we have. So the first one is what we call current service cost. So IAS 19 says that the current service cost is the increase. That's what the standard says, is the increase in the present value of obligations arising out of employee service in the current period. So arising. So this is the increase in present value of obligation arising out of employee service in the current period. So what the standard is saying is that at every point in time in each of those periods, let's say 5 years that the employee will work for the organization, employee will have contributed certain benefit to the organization and is expected to earn certain return per period up to the end of the 5 years. So that's the amount that the employee, I mean in terms of monetary terms, the amount that the employee will earn in that period say year 2 or year 3, that change from one year to the other, that increase the fund over a period of time to the end, when, okay, for instance, I said $100,000, so to the end of the $100,000, that the changes from period to period, the present value of that change is what is called current service cost. So so by the time we start working on it, so we will see what that means in real time. So the past service cost occurs, um, it's also a change. Let me use that word. It's a change in the present value of obligations, but this applies to the prior period because it's a past service cost. But in most cases, it occurs as a result of, maybe there's a planned amendment on the fund, or retirement plan that the organization has for the organization, or for the employees, or in terms of curtailment or any changes, amendment to it. So those planned amendment or curtailment, when we re-estimate, when we look at the present value of the obligations that the organization will pay, the change for those prior periods, because we will have accounted for it in a particular period. If there's anything changed, we have to do it again. So that difference, or change in the present value of obligation, for the prior periods, it's called, we call, past service cost. So when we solve a question, you will see what we mean by that. Then there's also what we call contribution to the plan. Contribution to the plan is simply payment of fund into the plan, into the plan asset. When we are making provision for liability to be paid over a period of time, it's expected that the organization will have created an asset, like a plan asset, so that it can liquidate its liability when the time comes. So that plan asset is also sitting separately somewhere else, while the liability that you can also accrue sits separately. But when we are doing, when we are charging this to the account in the statement of financial position, the standard says that what we recognize is the net amount from the plan asset when you deduct the plan asset from the liability. So that difference is what is to be. So we cannot at any point in time show a plan asset separately and also a liability separately in the financial statement. So we need to net it off. We now show the net value. So I'm just explaining that. So contribution to the plan is in form of periodic payment to the fund, so that the organization can pay its liability when it arises. The benefit paid is simple, very very straightforward. As a result of that, when we make continuous payments to the particular fund, there could be early retirement for some of the staff in the organization. So that benefit will have been paid in a particular period. So that benefit that was paid in that period is a benefit paid. Um, Another thing that we also need to talk about is, as a result of contribution to fund, I talked about asset and liability. Liability is the obligation that will arise from the retirement of the employees over a period of time. The asset is a fund that was created in form of money deposited somewhere, so that we can make good this obligation at the end of the day. So at every point in time, most of the time, let me say that the liability is always above the asset. I mean, the liability obligations of the organization is always above the planned asset. But in certain cases, it could arise that the asset will be more than the liability. That's where the asset ceiling comes in. So it explains. So if you see what I wrote, it explains a surplus. It explains that a surplus can only be recognized to the extent that it will be recoverable in the form of refund or reduced contribution in the future. So what this is saying is that the standard does not want us to have excess. I mean, in terms of surplus. So the standard is now talking about that. Okay, if any surplus occur, that surplus should be recognized to the extent of the amount recoverable in the form of refund. So let's assume we were supposed to contribute maybe $300,000 over a period of time, and a point in time is expected that, okay, when we do this monthly contribution that we want, or annual contribution, it should go above that value of 300,000. So there is a expected form of refund that is expected in that form. So as a result of that, that refund, or we need to find a way to reduce our contribution so that we can arrive at that $300,000. So that reduced contribution, or in the form of refund, that amount is what what the standard says that we should recognize as excess, as surplus, not the actual difference between the plan asset and the liability in terms of obligation to be paid to the employee. So that's what I'm trying to say in essence. And let's try to look at and another thing I didn't mention is that for IAS 19 employee benefit, there's a lot of actuarial valuation assumptions that needs to be considered when you're looking at because the standard says that at a point in time we need to remeasure the fair value of the plan asset and the fair value of the liability. So the fair value of the liability can only be arrived at, or the fair value of the plan asset, using actuarial valuation assumptions, not the actual discounting cash flow or anything that we prepare as a result of the calculating the liability from time to time. So there's actuarial valuation, and these actuarial valuation assumptions could be in terms of demographic, age of the employees, could be a lot of other things, number of years that the employees have spent in the organization. So it's a third party valuation that I'm talking about here. So that fair valuation will always come into effect from time to time. The standard says that that should be remeasured from time to time. So because when you see it in the question, I made mention of some terms like fair value of the plan asset or something. So that you know that where that is coming from. But for the purpose of this discussion, there's no way we'll go deep into actual valuation assumption. So let's focus on the questions uh, okay, the standards also talk about estimating the service cost. I talk about service cost and the liability over a period of time. So the standard suggested what we call projected uh, unit credit method. Projected unit credit method. So that projected unit credit method is what we apply in this example that we want to do. So let's go on and look at the example. So the question says ABC Limited intends to pay the sum of $1 million to some employees in exchange for their meritorious service to the organization between 2021 and 2030. I think that's a period of 10 years. This sum is due payable after the last day of employment in 20. So it means it will be paid to we assume that all the staff will retire at the same time. So it will be paid to all the staff at the end of the year 2030. And as a result, ABC Limited has also set up a fund as a plan asset to be able to meet this obligation. So I was talking about our plan asset investing in funds so that we can make good of obligations when they arise. So in January 2022, the fair value of the fund, the plan asset, shows $55,000, while a contribution of $50,000 was paid into the fund. So this is the fair value I was talking about, fair valuation of the plan assets that I was talking about. Why the contribution that was paid? In terms of the additional fund that the organization set aside to be added to the fund is $50,000. The fair value of the plan assets and liability. This is, we said in January 2020. This is the opening fair value of plan assets. So we should know that. The next one is fair value of the plan assets and liability at 31, which is the end of the year in 2022, and in 2022, yes, and amount to $120,000 and $130,000 respectively. So what we're saying is that plan asset is $120,000 and the fair value of the liability is $130,000. That is the remeasured value that we have. So note the applicable interest rate is 5% per annum. Require show all the accounting treatment in 2020. Let's limit it to 2022 so that won't complicate things for now. Then we can talk about others later. In 2022, in the books of ABC Limited, including relevant calculations. So let me put a solution here like we used to. We need to define the terms. What are those terms that we have? Value of the fund is 1 million, sorry, $1 million. The value of the contribution that we expect to make is $1 million. The next thing is the sum pay the sum this sum is due payable, yeah, as thus ABC has set up a fund. Okay, not that. In January 2022, the fair value of the plan asset shows, that is fair value of assets 1/1/2022 is 55,000. Yeah. Why the contribution paid to the fund? Contribution to the fund. Contribution to the fund is $50,000. Yeah, that's it. That's what the standard says. And the fair value of plan asset as at the end of the year, which is 31 December 31/12, is 120,000. It has increased to $120,000 from 55. And the fair value of liability is $130,000. So we need to define all this before we start our calculation. We spell them out so that it can be easy for us when we're doing it. So okay, then cost of fund, interest rate is 5%. That's what the carton says. So before we do anything, we need to first of all define, because what we have here, we have fair value of assets at the beginning, fair value of assets at the end, and fair value of liability in that period. So, but we could not see if there's any service cost there. We could not see maybe initial value of the liability, maybe present value of the liability. So we need to determine that. How do we do that? I will create like amortization table. So that table will have the years in it. We have 2021, where it's starting from. No, this is just number, not currency. Yes, no, 2030. Then that's the period of 10 years. Opening balance of obligation. And we have units of payment. We just assume that we spread the amount across that 10 years. Unit of payment, we call it unit of payment. That is what we call projected unit credit method. So let me use that word, method, the projected unit credit method. That's the method we're trying to use, so that we can estimate our service cost and other. So unit of payment, maybe in form of the $1 million divided by 10. That's what we have here. We have 1 million, or let me just say equals to this divided by 10. That's the number of years that we have. Um, Balance. We have opening balance plus this on the fund. If anything changes, so the opening balance, the closing balance here will be the opening balance of 2022. So I'll just copy down. So that's the first amortization that we do. Then we now need to measure, that is measurement of liability. So our measurement of liability, let's say that this is year one. There are 10 years, yes, in total. So 10 years. So the first thing we need to consider is the opening balance of obligation, because that's what we are trying to look at. What is the opening balance of obligation in 2021? Do we have any value? Opening balance, we don't know. Let me put the word 0 so that's the number we show. Yeah, number we show. Yeah, opening balance of obligation is 0. Is there any interest on opening balance? Because we charge interest on the balancing from time to time. So that interest is like interest payments in terms of expense to the account. So that interest that you're saying is something that goes to the P of profit and loss. Let me use P&L. Yeah, that's it. So interest that we have at 5% times 5%. 59. Then I can log it. So that's, I would do this way. Okay. We need to now know the discounted discounted interest. I call it DCF most times. Discounted interest is now we used to do that 1 divided by 1 plus, what is the interest rate? Interest rate is 5% raised to power. So what we are now looking at is spreading that $1 million across 10 years. So the first year will have the higher unit, and the first unit for the first year will be the difference between the last year. Because we expected that the fund will the staff will have retirement at the end of 10 years. So we now say that 10 years, which is the last year, minus the first year. So we have, which is the number of units that we have as the power. So I have to lock, I think I have to lock this one. Yeah, that's it. To go down till, oh sorry, I didn't lock C59, so I need to lock that also. You will see that when I did my discounted interest rates, everything is coming back to 1. So it's coming back to 1. So now we need to now apply this is service cost. Let me call it service cost, like I explained earlier on, which is units per period. Let me use that word, times DCF. So unit per period that we have above, which is 100,000 per each of, because I said, when I was talking about service cost, I said is the present value, increase in present value of the obligation for a particular period. So that increase in present value, you see that amount of $100,000 increases each contribution till the end of the 10 years, to when we have $1 million. So that amount is what we now use. So times DCF 64 coming, yeah, straightforward. We now have closing balance of obligation. So this closing balance of obligation is what is expected to be in our statement of financial position at the end or at the beginning of a particular period. So it's as a result of adding this plus this plus this. The first year, which is 2021, we have 64,461, and we'll continue that way till we arrive at that. So, and you know that this is opening, so the opening for the closing for a period will be opening for another period. So I'll copy down. You see that the whole amount will be 1 million. So did you see? So we arrive at that $1 million as the closing up. So at every point in time, what we're saying is that our liability, this value that we have here, will be our liability from time to time till the end, because we need to make this payment. I mean, this $1 million, can you see that the amount is fixed, but the returns that we pay from time to time is variable? Can you see? This amount that we use to service it is variable, plus the interest. Can you see? Interest that accrue on it, this is the interest on it. So this amount is variable over that period of time till we achieve that our $1 million. So our debit and credit here will now be, the way I would do it, I would want us to look at statement of financial position separately. Under statement of financial position, we have assets. That is the plan asset. We have the liability, and we have our statement of profit or loss, other comprehensive income, SPL OCI, and let me say net amount, because that net amount is what will sit in the account. So yes, yes. So what is our opening balances for both assets and liabilities? So the question has given us opening balance of assets, which is the fair value of the asset that we have as opening balance, fair value of the asset, which is 55,000. Do we have opening balance of liability in the question? No, we don't have. So we assume, because this is 2022 that we're trying to do, our opening balance in 2022 is this 64,461. What are those other things? Let me put debit and credit journals so that we'll have the understanding of how to flows in the account. Which account will debit, which account will credit? Debit, credit. So what is the next thing? uh, it says contribution to the fund. We have the fair value which we have recognized. We have the contribution to the fund. So this contribution to the fund, where is it coming from? So we need to be able to understand which account to pay it to and which account is coming from. So when we say contribution to the fund, it means bank payment or cash payment into the fund. It has nothing to do with the liability. The liability is what sits somewhere. We do not touch the liability because the liability is our obligations. It's only when we make payment from the plan assets that we have to credit we have to debit the liability to reduce our liability because we have paid from our obligation. So here is contribution to the fund. So contribution to the fund. Our contribution to the fund will be debited to plan assets. What's the problem? Contribution. So we debit plan assets, and we credit bank. Can you see how we make it? Yeah. So easy. Oh. So the next thing we need to look at is that's the fair value. That's okay. Interest rates. Interest rates can be in two ways: interest return. I mean return on plan assets. So you have invested plan assets with 55,000 times 5%. So that will increase the plan asset. So we debit plan asset like we did, and we credit um, income statement or profit or loss. So see the same amount goes to the profit and loss, P and L, as an income. So when is an income, we credit it. So we expect it to be negative here. So let's choose negative. So interest on liability that accrue over a period of time. So there's an interest on the liability also, just like we have here. So that interest on liability, we have already done it. So is what we have here. So in that year, 2022, that is the interest on the liability. So that interest and liability, we will debit P&L and credit liability. This will increase our liability over a period of time. So this amount will come here. The next thing to look at is what is the service cost. Service cost is what we charge to our profit and loss account. So we charge it because we will use it to increase our liability. So what's the service cost here? Our service cost for the year, which is the current year service cost, is 64,000. So can you see there's a service cost in year one? So that service cost in year one has become opening liability in year two. So we don't need to do anything on it. So we have our service cost in year two, which becomes what is to be used to increase our liability. And the same thing also go to P&L. So we debit P&L and we credit liability, just like what we did earlier on. Is that all? Yes, I think that is all for now. Okay, there's a remeasurement. So that remeasurement, we'll do that later on. So we need to sum this. So these two amounts sits in our assets and liabilities. Can you see that here the liability is higher than the asset? So at the opening period, the net amount that will be recorded in the books will be negative, which is the liability amount, and the same amount, the same deficit, because this is a deficit, it's not a surplus. So that deficit is what we have here. No, I don't, let me call it deficit. Yeah, it's a deficit because it's the amount that liability exceed the assets. So this is where I was talking about the asset ceiling. If this amount here, I mean the SFP here, is more than what sits in the liability, then we have asset ceiling. Then we start applying that principle of recoverability, or in the form of um, um, amount recoverable, and also in the form of what do I call it? I said in the form of refund or reduced contribution in the future. So, but we don't have to do that here because the liability exceeds the asset. So now the question now says that the fair value, because we need to estimate the fair value through actuarial valuation. So the fair value of the plan assets is 120, and the fair value of the liability is 130. So when we have that fair value, then it means there's a balancing adjustment here. Adjustment, and this balancing adjustment is expected to go to our OCI. So that's what the standard says, that any remeasurement difference in the form of gain or losses will be posted to the other comprehensive income. So now let's look at it. So in this case, we had an asset of 107 750, 107 750, but the asset value, fair value of the asset, is now showing 120. It means there's a difference, which is like a gain. So that amount is a gain. So when you have a gain, it means you would debit plan assets. So let me splurge it so that we can have another one for liability. So you have increased your plan assets and OCI. So OCI will be credit, then plan assets will be debited. So the other one is balancing adjustment, OCI, also for liability. So liability here, we have this liability, and if liability reduces, can you see our liability in the books, I mean in terms of the present value of the liability, is 135,368, but the fair value of the liability is actually 130, so our liability has reduced. So in this case also, we will we debit our liability because liability has reduced, and we'll credit our OCI. So it's the same thing. But if in this case the present value is less than the fair value, it means liability, fair value of the liability has increased. It means we will credit liability and debit OCI. So that is how we record our transaction as far as IAS 19 is concerned, employee benefit. So in my other videos, I'll be talking about other aspects of employee benefits that I talked about earlier on, in the form of short-term employee benefits, termination benefits, other employee benefits. So all those ones are pretty straightforward, but there's also some rules to follow when we are doing uh, uh, recognition and measurement of those employment benefits. Thank you.